Most people treat the stock market like a casino. They chase trends, time the market, and jump in and out of stocks without really understanding what they own. But there's one man who's done the exact opposite and become one of the richest people on the planet. Warren Buffett. For over 70 years, he's used a simple, patient approach to build a $100 billion fortune. In this video, we'll break down Buffett's 5 key rules for picking stocks, straight from his real portfolio, annual letters, and interviews. These principles aren't just for billionaires. They're timeless. And by the end, you'll know exactly how to evaluate stocks like Warren Buffett. Now before we start, remember, Buffett doesn't invest in stocks. He invests in businesses. Every share he buys represents ownership in a company he understands, trusts, and believes will grow for decades. And while most investors react to daily news, Buffett focuses only on what he can control, the value of the business, not its stock price. So let's break down the 5 filters Buffett uses to decide if a stock is worth buying or avoiding. Buffett's first and most important rule is simple. Never invest in a business you don't understand. He calls this his circle of competence. That means sticking to industries you can explain in one sentence. If you can't clearly describe how a company makes money, who its customers are, what its competitive advantage is, then you're not ready to invest in it. Buffett avoided tech stocks for years not because they weren't profitable, but because he didn't understand them. He prefers simple, predictable companies like Coca-Cola, See's Candies, or Apple, businesses with straightforward models and loyal customers. Ask yourself, is the product something people will still use 10 or 20 years from now? Does the company have a competitive moat like brand loyalty, cost advantages, or network effects? If yes, it may be worth a deeper look. If not, move on. Once Buffett understands the business, the next thing he looks at is management. A great business can be ruined by poor leadership. So Buffett asks 3 questions. Are the leaders honest and transparent with shareholders? Do they allocate capital wisely, reinvesting profits where needed, or returning money to shareholders? Do they admit mistakes publicly and learn from them? In Buffett's own words, you can't make a good deal with a bad person. That's why he studies the tone and content of shareholder letters, earnings calls, and interviews. If a CEO is spinning bad news or hiding data, Buffett walks away. Buffett only invests in businesses that are financially sound. He checks these 4 key metrics. 1. Low debt or debt-free. A company with little or no debt is better positioned to survive recessions and downturns. 2. High return on equity, ROE. This shows how efficiently the company turns shareholder money into profits. Buffett prefers companies with ROE over 15 to 20%. 3. Healthy profit margins. High margins indicate pricing power. If a company has to constantly lower prices to stay competitive, it's in trouble. 4. Sensible use of profits. Buffett looks for companies that either pay regular dividends or reinvest profits to grow earnings per share. If profits are being hoarded or misused, that's a red flag. Even a great business can be a bad investment if you overpay. Buffett calculates what he calls the intrinsic value, the true worth of the company based on its future earnings. If the current stock price is significantly below this value, he considers buying. That gap is known as the margin of safety. In 1973, he bought shares of the Washington Post Company for around $80 million, even though his calculations showed it was worth at least $400 million. Why? Because it had strong earnings, a dominant position, and a huge discount to its intrinsic value. Within a few years, that investment made him hundreds of millions. So remember, even the best stock is not a buy at any price. Finally, once Buffett finds a great company at a great price, he doesn't sell it. His favorite holding period is forever. He believes wealth is built by owning businesses that grow steadily over the long term. That's why he ignored the dot-com bubble, held through the 2008 crash, and still owns companies like Coca-Cola and American Express after decades. Most people panic sell during volatility. Buffett doesn't. He trusts his research, and he lets time do the compounding. As he once said, the stock market is a device for transferring money from the impatient to the patient. To recap, here's Warren Buffett's 5-step investing strategy. Understand the business. Trust the management. Check the financials. Buy at a discount. Hold for decades. These aren't shortcuts or hacks, they're principles backed by decades of success. You don't need to be a genius to follow them. Just disciplined. So before you buy your next stock, ask yourself, would Warren Buffett buy this? If the answer is no, maybe you shouldn't either. If this video helped you understand investing better, like the video, subscribe for more faceless finance content, and comment below. What's one company you'd be comfortable holding for 20 years, and why? We'll pin the best answer.